only you that was there in the range. So you think that's why the fees is higher during these events?
Yeah, it's kind of both. Like, well, it's both. Like, I am getting out of range, and also there's a lot of volume. Not I am getting out of range, but people getting out of range. If you have a tight range liquidity pool, right? Let's say you were farming like sold to USDC from like $200 to $250, you're pretty fast out of range in that dump, right? And then if there's like a ton of volume that comes from that dump, then you would have missed out on a ton of fees in the whole process. So that's why I personally prefer like, you know, wider range liquidity.
Gotcha. I think we jumped right into it. So maybe we should dial it back. Maybe you should introduce yourself and how long you've been in crypto for, how long you've been LPing for.
Yeah. Let me share my screen if that's okay. I've personally deployed over like 100 different LP positions. And these are like the wider range LPs usually. And some of them are like the blue chip positions. Some are pretty high risk degen plays, right? Like stuff like meme coins. So you could use like liquidity pools for a bunch of different things. And if you,
Mate, could you check if it's working right now?
yeah, let me share screen. So let me dive right in. The first slide is just a short introduction. My name is Richard. I've been in crypto for about 4 years since like 2021. I did swing traded some ETH like way back, I think in like 2017, 2018, but I kind of got sick. So then I didn't really stick with crypto, but I was still able to build like a few six-figure portfolio from just crypto alone, stuff like doing freelancing art, airdrop farming, trading, investing, and yield farming. And throughout the whole process, I did lose a ton of money, but I've also made a lot of money in the process. And I do have an investment consulting background. I worked in different markets like real estate in Asia and just stuff like traditional finance investments, buying different ETFs or just diversifying assets, managing like different portfolio sizes and stuff like that. And I did spend a few thousand hours throughout the whole process of last year learning yield farming. And I'm still learning as I go along too, right? I'm not saying, I know everything there needs to know about like DeFi and yield farming, but I did spend quite a lot of time studying concentrated liquidity pools because I did learn some basic concepts when I first got started, but I did run into trouble in like when following popular strategies or things that I see on like either YouTube or X, right? There's a lot of issues that comes with concentrated liquidity pools if you don't have a system in place. Stuff like, what do we do if prices move out of range? And then what plan do you have in place when that happens? So that's very important to have when you guys provide liquidity, and you want to have like a strategy in place to be able to handle these market drawdowns, right? We just saw one of the largest dump in the altcoin markets. And if you don't know what to do or you don't have like a plan in place, then that could be very challenging. And if you do the wrong things, like for example, you're out of range and then you rebalance downwards to chase a range, that could be a very fast way to lose a ton of money in the process. So that's kind of what I work on now. And I do have a YouTube channel, and on my X account, I post a lot about DeFi and yield farming if you want to check it out. But there's a ton of free content that I put out to try to help people with concentrated liquidity pools and with DeFi, because there are a lot of traps in DeFi, even stuff that is unrelated to concentrated LPs, right? So that's something that I try to help other investors with, to try to get better at so that we can lose less money in the process and make more money in the process. But basically, this presentation is for you if you want to make more sustainable passive income from crypto. If you don't want to, go into like the Ponzi high APR crypto, stuff like that, right? So the APR is sustainable if you run more sustainable strategies. And if you want to accumulate more crypto or altcoins, liquidity pools is a great way as well. Because sometimes you can't earn yield from stuff like Solana if you just stake Solana or buy like liquid staking tokens, or if you lend it out, right? But a lot of these like mid or even large cap altcoins, they don't really have a good way to earn yield from it unless you're doing stuff like concentrated liquidity pools. You can earn yield on your Dogecoin, for example, if you pair it with different tokens like USDT. So as long as there are traders that is trading stuff on chain, you will be able to earn yield. And then, if you are a trader or investor, learning about liquidity pools could actually give you a huge edge in the market because you could do stuff like providing one-sided liquidity to be dollar cost averaging out of your trading positions while earning some really nice fees in the process, right? So that's how you could be using liquidity pools. And if you're just getting started in providing liquidity, or if you've been dabbling a while, then this workshop is good for you. But basically, this is like more of a concentrated liquidity pool 101 workshop where it's mainly covering the basics. It's not going to dive too deep into like the advanced concepts. But hopefully, even if you guys have been yield farming for a while, you'll learn something in the process. But basically, this is like the main content for this workshop. We're talking about what is a liquidity pool, what is a concentrated liquidity pool, how is that different from like a full range LP, right? Why do we yield farm concentrated liquidity pools? How much can we earn from yield farming these pools? What are the risks that you really need to be aware of before investing or trying to actually yield farm these pools, right? And I'll touch on some common mistakes to avoid and examples of deploying LPs as well, so that you guys could have a pretty good process in like deploying LPs instead of just trying to do everything like without a process in place, right? So I can go over like the questions in a little bit here. The market has been pretty red yesterday, right? But I'll go over all of that in a second. But let's go over the content here first. If you don't know already, if you're able to swap tokens on like a on-chain place, like a decentralized exchange, stuff like Uniswap, Radium, Orca, Meteora, you're actually interacting with liquidity pools, right? The token has to come from somewhere. That's where liquidity providers step in, or different projects would actually provide liquidity for you to be able to trade these tokens, right? And this works the same way with meme coins as well. If you want to trade meme coins, there has to be some liquidity. And if the liquidity is very small or very thin in a lot of these tokens, the dump or the pump would be pretty severe, right? So that's why also why like the market, we saw a lot of red in the market. It's not because a ton of people were selling, it's because the liquidity in some of these altcoins are actually quite thin, right? But that liquidity is also on those centralized exchanges. There's not enough buyers to actually hold up like those perps. The order book on the perps platform is not thick enough to absorb those sells, right? And the same thing does happen in liquidity pools as well. If there's not a lot of the downside liquidity, like for example, for Sol to USDC, if there's not a lot of USDC in the pool and there's a huge supply dump for Solana, then the price drawdown is going to be more severe rather than like, there's a ton of the bid side liquidity inside the pool, right? But basically, when you guys are interacting with stuff like Radium, Orca, when you're swapping in and out of Solana, or on Ethereum, there's Uniswap, right? Then you're paying the fees when you swap, and those fees typically, some of it goes to the platform if the platform charges a fee, but a lot of it goes to the liquidity providers. And if you guys know how to provide liquidity, then that's a great way to earn some income to actually support your whatever other money making strategy that you're using at the moment as well, right? And we could dive in deeper. There's a ton of different strategies you could run, but that's the basic idea behind it. But why is there concentrated liquidity? Why not just use like a kind of like a full range liquidity pool? Stuff like Radium has a full range liquidity pool as well, or Uniswap V2, that's a full range liquidity pool. But the reason why concentrated liquidity pools exist is it allows you to set a custom range, meaning that, for example, if I set my Sol to USDC pool to be at $100 to about 275, I'm saying that, okay, I'm depositing this amount of token. And when traders trade between that range, I'm fine with that average exchange rate between those two ranges, right? So it allows you to basically leverage up on your capital and get more capital efficiency. So this allows traders to trade a larger amount when they're making larger swaps. If there's like concentrated liquidity, the slippage is going to be less and they're going to lose less money when making large swaps. So it's more effective for like traders and for investors if there's concentrated liquidity pool. And the upside as liquidity providers is that we would get more fees from it, right? For the last dump that we saw in the last 24 hours, a lot of it is from like the tariffs, but I believe there's a lot of manipulation as well. And we don't really know for sure what the dump is coming from. All we know is that like people were selling, right? We don't know exactly who people were selling. And like in that brief period, if you go to Radium right now and set like a wide range, you will see a huge number of like, 100%, 200%, 300% APR. But a lot of times that number is temporary if like the liquidity hasn't cashed up yet, right? You see this peak here. That's where the liquidity is the thickest. You will earn less yield when that happens. And, if the price go down and go to like the thinner liquidity areas, you will be earning more yield if there's really, really high volume. But yeah, that's why we yield from concentrated liquidity. And then if you kind of zoom out a little bit before you actually dive into the LPs, a lot of people do ask me like, how much can you actually earn from concentrated liquidity pools? The answer is it kind of depends on the risk you're willing to take and like what kind of APR is sustainable. A range that I like to give my clients and whoever I talk with is around like 25 to 75% APR per year. If you're investing into stuff like the altcoins like Solana and Solana to USDC, stuff like that, or if you're taking even higher risk with stuff like Pump to USDC, then you could be getting a pretty high APR on your capital. But the problem is the higher the APR, usually the higher the risk. If you guys are yield farming stuff like Coinbase Bitcoin or Wrap Bitcoin with USDC or Wrap Bitcoin with Solana, you're going to be earning less yield because a lot of liquidity providers are putting their money there and it is less risk. So then your yield is going to be less, right? So you could be looking at like, for example, 5 to 15% APR for like the blue chip pools. If you guys are running pretty wide ranges, that is more sustainable over the long term. And sometimes those ranges, you're going to be able to stay in range for like even years at a time, right? So it all depends on your overall strategy. Usually the benchmark is like 25 to 75% APR for wider range strategies on different altcoins. But again, if the altcoin performance suffer like what we saw this year so far, your performance is not going to be that great either, right? But if we do see a lot of altcoin action, like what we saw in 2024, yields could definitely go higher and you are going to be able to gain more capital gains in the whole process. So let's say you started with 100K last year because you got in at a pretty decent price. You might have rode that 100K to 200K just from the capital gains alone, right? And then you get like an extra APR on top of that. Let's just call it 50% APR. Then 50% APR on, let's say 200K is another extra 100K throughout the whole process. So it could be very profitable, but at the same time, if the underlying tokens that you provide liquidity for goes to zero, your liquidity pool would also go to zero. So that's the very real risk that you're taking, right? Yeah. Santen is saying a lot of people made money from LPing last night for pools within range. Exactly. That's why I will talk about it a little bit. And basically, if you guys look at my portfolio, I did make a pretty good amount on some of my pools yesterday. Stuff like Pendle to ETH. If we look at the details, let it load for a second here. But yeah, if you're able to stay in range, for example, the Pump to USDC pool with just like a couple $1,000s in the LP over the last 24 hours, I did gain like 200 something dollars in fees alone, right? So it is, JJ is saying it is high risk, high reward. It depends on your overall strategy, what underlying asset you pick. Typically, you don't want to have like too much altcoins if you don't want to invest into altcoins. So you do want to have like stuff like Sol to USDC, ETH to USDC, or stuff like ETH to wrap Bitcoin. But those yields are going to be less than like the lower caps or like the riskier altcoins. Again, like the higher the reward, usually the higher the risk. But you can see like over the last few days, for a wide range strategy, sometimes the yield is going to be quite low. And then suddenly there's a huge move in the market. Then we print like a couple $100 overnight, right? And 200 something dollars on like a 8,000 something liquidity investment, that's about like 2 to 3% return overnight. So that's quite good. And if you're buying and holding those assets anyway, typically like LP is a good way to actually make money in the market while you're waiting for like the plays to appreciate in value, right? So
What do you think is like a minimum amount liquidity provision you could do to make it worth the time? Because I don't think a lot of people would have 100K to spend on a liquidity setup.
yeah, so in my opinion, for most people that has like less than 10K, you would be better off just running very passive strategy, like a very wide Sol to USDC pool, for example, if you're very bullish Solana. And if you guys are inside this Discord, then you probably have some exposure to Solana, right? Or stuff like ETH to USDC. If you're bullish on the underlying asset, you want to set wider ranges. And those wider ranges could take like only 10, 15 minutes per month to actually manage, like by claiming the fees or compounding some of the fees, right? So the time investment is not that much. Yeah. But I would
So you would say
suggest,
like
yeah,
10K is a good starting point.
yeah, 10K is a great starting point to work towards if you don't already have 10K. And if you guys are a longer term investor into crypto, you typically want to put more than 10K into crypto anyway, right? Or at least earn that amount through like other methods, for example, farming airdrops or trading or whatever. Yeah. But 10K is a good base. But obviously the more the better, because if you have like a larger capital, let's say you have like a couple $1 million, you only have to make like 10% yield per year and like use a very conservative strategy to make a ton of money, right? But let's say you only have like 100K or like even just 10K and you're trying to live on that amount, it's going to be very difficult. You're going to be taking too much risk. And then oftentimes if you take too much risk, you will end up losing a lot of money over the long period of time, right? If the market is very risk off. Yeah. Yeah. That's hopefully that kind of answered your question. And there are a ton of risks when it comes to yield farming concentrated pools as well. And a big part of learning about concentrated LP is to be able to learn about these risks and be able to manage these risks or even to profit from it, right? The first thing to understand is that concentrated LPs do have a steeper learning curve. You're not just buying and holding, right? Or you're not just trying to trade a particular token. It is more complex than that because, for example, we could be yield farming the same exact pair, but we could be having very different goals, right? And we could be swapping from completely different tokens. For example, if we are yield farming Sol to USDC, but I'm swapping from USDC, then I want to try to get in at a very cheap Sol price, right? Because essentially I'm buying Sol when I'm swapping into the pool. But let's say on the other hand, you have hold a ton of spot Sol and you rode the price appreciation all the way to like above 200 something dollars. You could actually use liquidity pools to lock in some of that profit. And then if you believe the drawdown is coming, you would gain more Sol in the drawdown, right? So my entry would be actually better if the Sol prices are higher rather than lower. So there's a ton of things like that to learn. And your impermanent loss can be greater than the fees that you generate. If you don't know what impermanent loss is, it basically compares the benchmark between what you deposit into the pool and what you hold in the market, right? So let's say for a very simple example is, let me pull up a chart here. Sorry, it looks like I can't hold the chart open because I am doing that push to talk thing. But let's use Solana. If Solana is trading at $200, and then you're depositing, let's say 10 Solana for a full range LP, you would actually be depositing $2,000 worth of Solana. But then you also need to come up with $2,000 of USDC if you are yield farming SOL to USDC, right? Because in a full range, you need a 50-50 deposit ratio. But let's just say Solana goes all the way up to $1,000. Whatever SOL you put in that case is 10 SOL that is inside the pool, is going to be slowly sold into USDC all the way up, right? So compared to holding in the market, if you just hold 10 SOL and then $2,000, if you just hold in the market all the way to $1,000, you would have more money because you're not selling any SOL on the way up. So you get full price appreciation. But the downside with that, just buying and holding, is that throughout the whole process, you're not going to be earning yield unless you're staking the tokens or you're loaning out your tokens, right? And then you could be also round tripping your bags. For example, you see Solana from $200 jump to $1,000 and then drop back down to $200 if you don't take any profits. So there's like a trade-off with the strategy. And if your range are wide enough, sometimes if you stay in range long enough, you will be able to outperform holding in the market. If you look at my current portfolio here, if you include all the close position, I've had a pretty good track record when it comes to just beating holding in the market or even making a profit in general, even though altcoins have been quite challenging to make a profit from this year, right? But of course, sometimes when the market is really weak, you will be sitting in like a lot of unrealized losses if you are still holding on to those positions, right? And that's in the nature of like just buying and investing. If you buy at a higher price or if you deposit at a higher price, you will be sitting in some unrealized losses until the prices do recover. So yeah, so impermanent loss can be a concern, but with a wider range strategy, it's fairly simple to outperform impermanent loss. And a lot of times our goal is not really to even outperform impermanent loss, right? For example, one setup that you guys can use is a one-sided pool to DCA out of Solana. And you could still be earning some pretty decent yield in the process. You could be setting whatever price right now as a lower range, right? And then a max upper range. That way you will be getting more capital gains. You will have a less aggressive conversion rate. And then the impermanent loss is going to be very small as well. So impermanent loss could be a good thing if that is like your goal, right? If you're trying to DCA out of a certain asset, or if you're providing liquidity for stuff like Bonk to Solana, you're trying to DCA your Bonk into Solana, then you could use liquidity pools for that, right? And you could be gaining a net Solana profit in that process. But the risk also is like if you run bad strategies because maybe you have heard of some like misinformation or you just don't know that much about it, like the range chasing strategy, typically it's not a good strategy. Range chasing is basically, let's say you set a range from like $220 to $250 for Solana. Solana drops right now to 186, 187. You rebalance down to chase the range, and then you are taking the underlying asset risk. For example, I showed you guys the Pendle to ETH pool. I am exposed to Pendle to ETH. If either of those tokens don't do well, then whatever funds that I put inside the pool is going to decrease as well, right? If you guys are providing liquidity for stuff like Trump to Sol, for example, and if Solana doesn't do well, then that LP is not going to do well. If Trump doesn't do well, that LP is not going to do well. So, or both of them don't do well, then that LP is not going to do well as well. So whenever you guys are yield farming that asset, you are exposed to the underlying asset risk. And then there's also smart contract risk. So if different protocols like Radium gets hacked and then your funds are inside the liquidity pools, and you could be losing some money there, right? For example, the popular example is the SUI with the CEDAS protocol that got hacked. There's like a couple 100 million that got hacked. And then some investors did lose money from that, right? So there's a ton of risk when it comes to concentrated liquidity pools as well. But you just need to know how to manage this if you want to make a consistent profit from it.
Richard, Santan was asking if you could run through the single-sided DCA out strategy again.
Yes, let me change like the push to talk button really quick and see if I could change it to other stuff so I could pull up trading view. Sorry, give me 1 sec. All right, so the DCA strategy is fairly simple. For 1 sec. Boris, I am recording. I will be putting it on my YouTube channel and you should be able to watch the replay for that. But basically, for Solana and USDC, if your goal
Are you
is
able to talk without the push to talk button, Richard?
1 sec. Let me try. I think the push to talk is required.
Plank is here. So Plank was telling we could go to the amphitheater where there's much more freedom and you might not run into these issues. Do you want to do that or do you want to continue?
Yeah, let's do that so that the trading view works, if you guys don't mind. Yeah.
All right. Sorry about that, guys. If you could all jump into amphitheater in like 2 minutes, we can continue where we stopped. Thanks a lot, Plank.
All right. Thank you. See you guys there.
I think we are good. We should probably start.
So a very simple example of a DCAing out strategy with a, let's say, SOL to USDC is by using like a one-sided liquidity pool, right? Or sometimes if you want to be in range right away, you could be selling some. For example, I'm on Orca currently. I could be setting my lower range to be at like, let's say $150. And in this case, you would see I would have to deposit 90% SOL and then like 10% USDC, right? So if you guys don't have any stable coins, you're holding on to a lot of Solana and you want to put it inside this pool right now with this current range, you would actually need to sell some Solana for this case, right? And there's a handy tool for like calculating impermanent loss. I dropped the link inside the chat, but basically you could use different tools like this one to help calculate impermanent loss before you deploy. And you could simulate the APR as well. And basically, this is typically what I do before I even put the funds into the pool, right? You kind of want to know like the expected value out of the position based on like your different price target and your overall strategy. We were just looking at price lower to be at $150. That's our lower range, right? If I set an upper range of pretty much close to infinity, then I would be able to actually DCA at a better exchange rate than if I set a range to be too tight, right? And then if the price now is at 186, it's exactly what we were looking at. You can see that the deposit ratio is kind of what Radium was showing, right? 90 something percent X is the SOL in this case, and then Y about like 9.3% USDC. And this chart shows you like the exact impermanent loss you would suffer. And let's just say you started with 100K in this instance, right? Just to make the number more simple, of course, it could be $100, $10,000, $1,000, or even $1 million, depending on how much capital you guys have, right? But let's just say the price jumps to $300. And again, because you are selling some SOL in the process on the way up, you're not going to have the full maximum capital gains in this case, right? If you held the deposit ratio, so 90% SOL and 10% USDC, you would have 155K in this case. But if you are in the LP, you would have 149K. So the difference here is this 4.3% impermanent loss number. So we could actually know the exact impermanent loss that we would suffer based on like our own price targets before we even deploy. And theoretically, if the APR is high enough to cover the impermanent loss, then this strategy would be more profitable than just holding until $300 to be realizing your profit, right? If that was your profit target. And we could use different tools like Crystal, for example, is a free tool to help simulate. And then there's also paid tools like Metrics Finance, which works particularly well for Orca and Radium, because sometimes different free tools like Crystal doesn't support Orca as far as I know. So yeah, there is Radium. So let's say I go to that Radium tab. I am able to pull up some pools here. And sometimes, let me see. So hot pools, I would go to this Solana tab. And then you can see a bunch of different pools to try to estimate your APR, right? And then we could go to stuff like SOL to USDC. The volume seems really high compared to the total value locked, right? So this is probably the best pool on Radium currently. You could go here and then simulate your APR. So, but one thing I will say is that the estimated APR, which is at the bottom right corner here on Crystal, is not as accurate as like different paid platforms like Metrics Finance, simply because it uses the 24-hour APR. And then when we see like a huge spike in volume, like what we just saw in the last 24 hours, then the APR could be out of whack, right? But the idea here is we could go ahead and simulate. Let's say minimum range is $150. Max price is like close to infinity, right? And then if I see the bottom right here, the yearly APR is at like 100 something percent, but simply because the 24-hour volume has been quite high. But what you can see is you can look at the APR, historical APR as well, and kind of compare. You can see that huge spike here is like 200 something percent in the last 24 hours. So maybe your actual APR is around like 1/4 of that, right? So maybe at like 50% or less usually over the last month or so. And currently it only shows us like the last 30 days, right? So over the last 30 days, maybe the average APR is 1/4 of that. So if this is showing us 128%, 1/4 of that is around like 20 to 30%. But with a wide range like that, that's still a very, very solid APR. And something we got to consider as well is the concentration of the liquidity is not at the peak. So the estimate would be higher as well. So maybe the actual APR is only around like 10%. And this is something we could simulate with Metrics Finance here. But let's just say I want to do SOL to USDC, but let's do this Orca pool instead, right? So Metrics Finance has Orca. It is paid though. It's about like $50 for the cheapest plan. And the cheapest plan is what most investors would need. So you don't really need like the more advanced features. Basically, the minimum price is 150 to like max price of a million, right? Or whatever really high number. You could change this custom price. If the price stays at this average liquidity, you would have about 25% APR based on the last 30 days volume. But you could extend the estimate as well to, let's say, 180 days. And you can see the volume has been fairly constant. Sometimes there's like a huge spike in volume. And you can see over the last 180 days, and sometimes the range just kind of move. So let me adjust it real quick. You can see even with a sufficiently wide range, it's at like 20 something percent APR. So in this first stage, we saw that if Solana goes to $300, we were suffering 4.3% in per loss. But if I was to stay in range for one whole year, I would be earning roughly 20% APR, right? So it's completely fine to be suffering this impermanent loss if I'm planning to buy and hold Solana anyway for like a higher price target. So that's why it's very helpful to like know how to use this tool and kind of like see how you could be actually earning a nice income from it and potentially outperforming just holding in the market. But basically, when we are trying to deploy into a liquidity pool, these are the main things that we have to worry about. And if you are able to master these 5 things, you would be better than like 90% of other yield farmers, simply because if you lose money, it's typically from one of these things. And if you don't lose money, then you would make money, right? Warren Buffett says like rule number 1 of investing is to not lose money. It sounds simple, but it's very hard to do, right? But basically, this is what I call the LP pyramid. I came up with it. And if you actually master these 5 things, the chances of you making money in the market is going to be way higher than people that actually don't have this framework in mind, right? The first one is the asset selection. So if you're providing liquidity for assets that you're actually not bullish on or have the chance of moving up in value, then your portfolio is just going to bleed out over time, right? But if you guys are having like a good blue chip allocation in stuff like Bitcoin, Ethereum, Solana, like maybe 80%, 90%, or even 100% in those blue chip assets, then providing liquidity becomes much safer compared to if you guys are providing liquidity for like 100% the lower cap altcoins or meme coins, for example, right? So you need to really be careful with the assets that you provide liquidity for. Chances are, if you are providing liquidity for tokens that bleed out or just don't have good fundamentals behind it, or if the market is just really weak for these altcoins, then your portfolio is going to suffer as well. You might be suffering less than people that just buy and hold because you're earning fees in the process, but you could still lose money over time if these assets trend down in price. And the second mistake is just not looking at the relative strength of the assets. So what I mean by relative strength is if I go back to like Solana, if I'm providing liquidity for Sol to ETH, what I want to do is I want to be aware of what I'm betting on and my entry and my exits. For example, if Solana is very overvalued compared to Ethereum, then hopping into this pool with your Solana is going to be safer, right? Because you're actually selling some Solana for some Ethereum at a pretty good exchange rate, let's say at this 0.09 here. And then you're riding that downtrend downwards. If you set a sufficiently wide range, you're gaining more Solana in the process. And it works the same way if you're swapping from Ethereum and you want some exposure into Solana. You believe that Solana is going to outperform Ethereum in the next 6 to 12 months or even in the next few years, then you want to try to get in at a cheaper Sol ETH price, right? Because that means that I could be buying more Sol for a cheaper valuation compared to, swapping all the way up at like near its all-time high. So that's something to be very aware of, the relative strength of each asset, what you're swapping from, and avoiding the mistake of like making bad swaps, right? Even stuff like ETH to Bitcoin, it doesn't make sense to buy a bunch of ETH with your Bitcoin if ETH is like historically outperforming Bitcoin by a lot, and then Bitcoin is very weak compared to ETH, right? And then the next thing you need to know is the sizing. If you are putting too much size into a higher risk LP, just know that the risk of losing money is going to be much higher versus then, doing like an 80 to 20 approach, right? Your 80% is in blue chip assets, and then maybe 20% you're trying to look for outperformance. That's typically like a good split for most investors. If your portfolio is small, you could try to go higher. But of course, if the market is really weak, like what we are seeing in 2025 so far, your performance is not going to be as good as, having a bigger blue chip allocation. The fourth is if you set your ranges too tight, then you could be doing stuff like rebalancing all the time. You're spending a lot of time to manage it. Someone did ask like how much money do you need to start with yield farming, right? You could start with any amount. I would suggest working up to 10K or above to make it more worth it for your time. And obviously the more the better. But if you guys are setting the ranges too tight, typically you have to run more active strategies. And those strategies don't necessarily mean higher profit either, because the tighter the range, the more risk you're actually taking because the exchange rate is going to be very aggressive, right? For example, if I'm yield farming Sol to ETH, and then I'm setting a range where it's like $260 to $220. When the price dumps really aggressively, like what we saw in the last 24 hours, and if the price do keep trending down, I basically bought a bunch of Sol at a very high price if I deployed USDC to begin with, right? And even if you guys deploy Solana to begin with, why not set a wider range so that you can stay in range for longer and the APR is more sustainable? Like the very high APR that you guys might see when browsing on X or whatever, oftentimes it's not very sustainable if you run a tight range strategy. So that's something to be very careful of. Oftentimes people set the ranges too tight rather than too wide, because if you set the ranges too wide, you would be earning less yield, but the chances of losing more money from capital losses is going to be much lower than if you do a tight range strategy. And then if you get a bad entry and bad exit, that could be a bad thing as well. For a pair like USDC and Sol, it's quite simple. If you're swapping from USDC, you want to try to enter at a cheap price. and then you could exit at like a higher valuation, right? So a very simple way is to get in at like a zone of support here. So sometimes it takes a lot of patience. Let's say like $125 to $130. If Sol get to that low of a valuation, it could be swapping some USDC into a Sol to USDC pool, right? And then a good exit target is just where a resistance is likely to come in, right? Maybe at like $250, or you could front run it a little bit, maybe at 225 if you want to set like a more conservative exit target. If you're trying to just capture that one swing upwards, right? And I did have a client position that I helped manage. We took the swing up from like $176 and then close out of the position at like 245, right? And then that's a pretty nice profit. And you can see sometimes if you didn't take profit, you would have been riding the price trend downwards once again. So sometimes the entry and exit doesn't need to be perfect, especially for the blue chip pairs, because there's different strategies like compounding down into the LP to drag down your entry. If you guys compound when prices are below your entry, you're actually dragging down the entry a little bit, and then it's going to make it much easier to turn a profit over time. But that's why I put it like at the top of the pyramid. The base of the pyramid is the most important, the asset selection, right? If the asset could survive like the next 10 to 15 years, could trend up in value in the next 10 to 15 years, then providing liquidity becomes a much safer thing to do. And like I said, there's contingency plan, like, compounding down into the position, right? But I just showed you guys how to deploy stuff like Sol to USDC. And basically you want to make sure that you're running simulations beforehand, and then you're estimating the APR beforehand rather than just hopping directly into the pool, right? You gotta know like the expected upside and the expected downside. Let's say I'm trying to optimize for fees. A range I might set would be like $150 to $500 if I want a wider range strategy. And I expect a bigger move upward from like if there's an altcoin season, right? Then that's a potential range I could set, or maybe even a wider low range at $100. So I could be simulating, for example, okay, how much money would I have if Solana drops all the way to $100, right? So this is that price now tap goes to $100. I would be suffering a roughly 39% loss from this current price point, and it's 15% more than just buying and holding those two assets separately, Sol and USDC, right? But if my fee is greater than 15%, then I'm comfortable to take that risk. But if the price do go up to, let's say like $300, like what we were just talking about, then I would be gaining a potential 25% APR if I'm inside this liquidity pool, right? Sorry, not APR, but the capital gains. But yeah, the lower the entry, the better the risk and reward it's going to be, right? If I entered at, let's say, $120, then my potential upside for a 100K investment becomes $171. So that's something to consider as well. But yeah, I think we're running out of time a little bit, and you guys could check out like on my channel how to deploy a crypto to crypto pool. If you're interested in stuff like Bonk to Sol, I think it might be a bit more helpful to go over any questions. Yeah.
In the previous stream or in Acropolis, one person asked the helpful tools that we could use for determining the ranges and potential profit, and as well as calculating impermanent loss.
Yeah.
I think you covered some of it.
This tool you should be able to know how to use, because some networks like Sui, it's not supported by some of these tools. Maybe they've added it, or they will add in the future. So you do need to know like how to use this Desmos impermanent loss calculator. You could Google this as well. Just Google Desmos Uniswap V3 impermanent loss calculator. And then if you want to look for a paid tool, then Metrics Finance is a good tool. It's one of the more complete tools on the market right now. And I am working with like a developer, my business partner, to build some like LPing tools, but that's probably going to take like a very long time to complete. But this is like one of the best tools right now available on the market. You can simulate positions. You could filter for stuff like, for example, fees to total value locked. That's typically a very helpful metric. For example, grass to USDT is pulling quite a high fees to total value locked. But I'm not sure like about the underlying assets, right? You gotta look into the underlying assets, for example, cards to USDC, altcoins like that. For Solana, you could also try to use Crystal if you don't want to pay for metrics, but they only support Radium right now. So you're out of luck if you're doing stuff like Meteora or other different decks. But another useful tool is also Gecko Terminal, because what you can do is you could estimate the volume of a particular pool, right? And you could do stuff like, for example, filter for like the higher caps. If I filter for like the larger caps, for example, you could do stuff like filter for the higher FDV tokens, filter for volume, liquidity, and then you could double filter the volume here. And you can see one of the larger volume pairs in the last 24 hours is BNB and USDT, and then Sol to USDC, E to USDC. And then you're able to find out like, okay, where is this pool being traded on? And a lot of times these platforms, these dexes do give you an estimate APR as well. But we want to make sure that, to double check the volume, right? For example, this pool is on Orca. So sold to USDC on Orca. So I could basically double check if like I'm in the right pool by going to Orca to sold to USDC. It shows about 50 million total value locked here. Last 24 hours, about like 1.2 billion. And it seems to be the same pool with this desk screener. Sorry, not desk screener, but Gecko terminal tool, right? So what I could do is throw on like a moving average on the volume to make sure that the volume is actually consistent at around like 2 billion, right? You can see the average volume is around $2 billion over the last 20 days or so. So I would then be able to better rely on like the APR estimate. And if I zoom in to the liquidity that is in range, then like the APR estimate could be a little bit closer to what I would expect, right? But that's, yeah.
I don't know how much time you got left, but I think Agarwal asked one question if you want to take it. He wanted to know what was your worst and best LPing decision or experience.
So let's see here. Position. So one of the worst ones is probably, this is like an experiment position, not a big loss, Vader to ETH, but Vader did get dumped pretty aggressively. Okay, so maybe the worst one is probably Magic. I guess it doesn't pull up. Let me try to pull it up. I don't have to show like the actual profit and loss because the data could take a while to load. But if a token bleeds out pretty aggressively over time, like Magic, because crypto gaming actually has been doing pretty bad this cycle, you can see Magic has basically bled out over time, right? Even in the bear market, it was trading at like $2. Now it's trading at like 0.12, right? So I was pairing Magic to ETH, but basically if this happens, you're in a very rough spot because to earn yield, you have to actually be in range, right? And unless you're setting like a max lower range pool, you're not going to be in range throughout this whole dump. And even if you're in range, it's very likely that you will be bleeding out in value in terms of ETH value of the LP. So let's say I put in like 10 ETH at a higher price point, the fees are very likely not going to be able to sustain a huge, like, let's say 90% dump. Because you gotta consider, like, let's say you start with 10 ETH, your LP value drops to like 3 ETH. It takes like a huge amount of APR to be able to recover from 3 ETH to like 10 ETH, right? So you need like, for example, 3 ETH to 10 ETH, you need like 100% APR over like, 2 years just to be able to recover your investment. So this is why it's not a great idea to provide liquidity for tokens that could potentially bleed out too aggressively. Yeah. And the best pool is probably MOG. In 2024, MOG was pulling a ton of fees. And because meme coins were really hot last year, and a lot of alts are quite hot last year. So if you're able to enter at a cheap valuation, I'm still currently yield farming MOG, but memes haven't, like altcoin in general has just been very weak in 2025, right? So, but the idea here is if I enter here at a cheap price with, let's say, 10 ETH, to just make the number simple, I could ride that price appreciation upward. My LP would be gaining in ETH value, let's say jumps to like 20 ETH. And then I would be earning like, let's say 100% APR throughout the whole process. So my net profit could be like, 30, 40 ETH if you're playing with like a very large amount, right? And this is especially true if you guys get in at like stupid cheap valuation for some of these tokens. So that's how yield farming altcoins could be very profitable if these altcoins do take off and kind of sustain for like a while, right? At least like 6 months to a year. Yeah.
And one last one from me. What is your current play in this crazy, crazy market? Did you do any changes? Did you get into any new positions?
So there's a couple things I'm doing. The first is I'm stacking more cash just because we're kind of like getting pretty deep into the cycle if you believe in the 4 cycle theory. And I am still bullish on like these mid to small cap altcoins running in the next 6 to 12 months. I don't know when that is going to happen, but I don't really want to sell my holdings at like this current price either. But I am stacking cash by selling my fees more into cash, like more into stable coins. And then if I make like other incomes from like airdrops or from like working as an investment consultant or other sources of income, I am stacking more cash on the sidelines. Because if we do see like a big flush in the market, let's say we saw a bunch of liquidation just in the last 24 hours, right? I could take advantage of that. I'm pretty heavily into alts already, so I'm not buying at these levels. But if I see like, for example, if I pull up the others chart and others drop to like 150 billion and then, sometimes even lower, then I could consider like, dollar cost averaging into even more altcoins, right? But mainly I'm adding more to my blue chip assets as well, simply because I came from like the ETH NFT side of things. I never really held that much Bitcoin. So I'm trying to change that over the last year or so. Yeah.
Sure. Oh, sorry, I had this one last question, but
Yeah.
Meteor basically to do LPing on Solana. So they have the bin structure in Meteor. So you have like 80 bins or 100 bins, etc. So to put my LP into a long range, I would have to have like a 400 bin setup basically. But there isn't enough volume or liquidity in it. So what I thought to do was put half of it into an 80 bin structure with one-sided LP. So let's say half of it I would put as Solana, and in another LP I would put the rest of it as USD. So basically two one-sided. Do you think there's any negatives to that?
So like same exact range, but like you split it into two LP, right?
Correct. Yeah.
Yeah, I don't think there's like a negative for that as long as your ranges are wide enough. Yeah. That's my issue with like that bin system as well. I believe the Trader Joe had that on AVAX, and it's just a bit tougher to be like providing liquidity with the wider range strategy, right? Yeah. It's not a big deal with that. Yeah.
Oh, cool. 15 minutes past and a lot of time, but thank you so much, Richard. And is there any closing statements that you would like to?
Let me answer one last question here. Can Yeah, can the LPs be automated? So there are tools like DeFi that automates the yield farming process for you. But again, with what I say about like range chasing and stuff like that, it often becomes unprofitable because their ranges would get like knocked out of range from like the tighter range strategy. So you got to be very careful with like the automation strategy, right? So it could be profitable or it could be very unprofitable over time, depending on like the strategy that you execute. There's platforms like VFAT that you could use to auto rebalance. But in my opinion, people lose the most money when they rebalance. So you gotta be very careful with like automating rebalance. But you could do stuff like automating the auto harvest on VFAT, for example. The website is vfat.io. You could double check on X and stuff like DeFi Llama to check if it's legit. But the auto compounding and the auto harvesting is less of a harmful thing to do, in my opinion. But you can see stuff like ETH to USDC pool on Beefy. They auto rebalance, auto compound the pool for you. And let's see like the 1 year performance, right? And again, I don't have like anything against Beefy. I think it's a great tool. But you gotta be really careful with these volatile pairs like ETH to USDC. You can see ETH price was trading at 24.86 and now it's trading at 38.33, right? So you would still be up about like 50%, more than 50% if you just buy and hold. But if you look at the price of the LP, which also already included like the rewards from the LP, right? You can see the price started at 779 billion and now it's trading at 756 billion. So you would have lost money with a range chasing strategy, even though it shows you like a, really high APY, right? Like for example, an average of 141% APY. So you're actually not able to retain their earnings simply because the impermanent loss that you lock in is greater than 100 something percent over time. You're doing the stuff that I mentioned of like not to do, stuff like rebouncing up, you're buying higher, and then you're rebouncing down to sell lower, right? You're buying high, selling low. Repeat that enough over time, then you would lose money. But that's pretty much what I would say. Try to think through like the worst and the best case scenario for when you're providing liquidity. You should be fine with either scenario. If you're yield farming sold to USDC, or you're trying to optimize for fee, you should be fine with being stuck with more SOL or being stuck with more stable coins. So that's like the worst case scenario for like a pool like that, right? But for like the higher risk stuff, it could be a little bit trickier, like bonk to SOL. If you're not okay with holding a bunch of bonk, then don't put your whole portfolio to yield farm bonk and SOL, right? Only put the amount where you're comfortable betting on that underlying asset. So that's pretty much it from my end. Thank you guys for attending the workshop. And again, you guys can follow me on X and YouTube if you want to learn more about yield farming. There's a link in my bio as well. So go ahead and check that out if that's something you're interested in.
Yeah, thank you so much, Richard. Yeah, I would suggest you guys, if you're interested in helping, to check out his YouTube channel. It's free. He's been in around this space for a long time. So, full disclosure, I am taking his course, so I'm a bit biased, but there's nothing wrong in taking the free classes in YouTube. And if you like it, you can move ahead with it. But thank you for joining us, and maybe we'll set one up later in the month or something.
Yeah, let's do that. We could do like more intermediate and advanced lessons as well. Thanks, Grizzly, and thank you guys for attending.
Awesome. Thank you, man. See ya.
Yeah, see
Thank
you
you.
guys.
It
Thank you.
Yeah.